Hello everyone, thanks for checking out my video. All three major indexes rebounded strongly in November by posting at least an 8% gain last month as they snapped their 3-month losing streaks. Not just that, these major indexes clinched their 5th straight winning week as well. And then on last Friday, the S&P 500 closed at its highest level of 2023 as the stock market is currently filled with growing optimism that the Federal Reserve was done with raising interest rates and could begin to cut them next year given the cooling inflation. In this video, I have some interesting statistics to share with viewers, and there is also something that is worth paying attention to in the first half of December, so do watch on to find out more. Alright, November's monster rally was basically powered by optimism that the Federal Reserve is done with hiking interest rates, as the market saw good news from the inflation data. So last Thursday, the PCE index, aka the Fed's preferred inflation measure, came in line with expectations. Not just that, the core PCE gave a 3.5% reading for the month of October, which was a decline from September's 3.7% and was also showing a downward trend from 4.3% back in June. More importantly, the latest figure indicates that inflation has cooled to its lowest level since 2021. Therefore, how can the market not continue its rally, right? I mean, before the release of the new data, investors were already forecasting that the Fed was likely done hiking. Some are even predicting cuts during the first half of 2024. Next, we had Powell delivering a speech last Friday, and his speech was interesting. Why so? Well, it's interesting because the things that he said can be interpreted as dovish, yet it can also be deemed as hawkish. In short, it really depends on how an individual wants to spin his speech to suit one's narrative. But honestly, who cares about what we think, right? It's all about the stock market. Apparently, the market pretty much took Powell's comments as dovish when he said that the risk of hiking interest rates too much and slowing the economy more than necessary have become more balanced with the risk of not hiking enough to control inflation. At the same time, Powell didn't want the market or general public to be too complacent, as he also mentioned that the Fed will move carefully on interest rates and are prepared to tighten policy further if it becomes appropriate to do so. In addition, he further reiterated that they need to see more evidence that inflation is on its way back to the Fed's 2% target. Well, to me, these comments are not new. He has been saying this for the longest time, and I guess the market thinks so as well, and view Powell's comments as inching towards the dovish side. This could also be the reason why we had an intraday reversal during the second half of trading on Friday. In terms of market outlook, the last FOMC meeting of the year falls on 12 and 13 December, and the market is widely expecting the Fed to hold the interest rate at current levels again, basically just stopping short of declaring victory in the fight to bring down inflation. The key catalyst for the stock market from now till January will be the market's prediction or expectation of the Federal Reserve monetary policy, or probably specifically the period of rate cut. So would the rate cut be in the first quarter or first half of 2024, or would it be towards the end of 2024? Nobody knows. The market is basically just moving based on expectations, or what we call pricing in the future. So follow along the trend if you can. But yeah, I know it's not easy. More on that later in the technical analysis segment. Just to add on, come this week, investors will be paying attention to the release of US employment data on 8 December, as the market would want to see whether the economic growth is continuing to level off. So other factors that could potentially move the market in December would be tax loss selling and the so-called Santa Claus rally. I will cover more of this in the End Thoughts segment. But meanwhile, some interesting statistics to share, and that is, according to CFRA, December has been the second best month for the S&P 500, with the index up an average of 1.54% for the month since 1945. It is also the month that is most likely to give investors a positive gain, with the index rising 77% of the time. So remember, don't fight the trend, and in this case, the bullish trend. unless of course it bends. So how do we know if the bullish trend bends? Let's discuss this in the next segment, the technical analysis segment. Okay, starting the technical analysis segment with SPY again, which represents the S&P 500, aka the broader market. Well, 10 green candles in the last 13 trading days, so I guess I don't need to tell you that the market is very bullish now. What is even more bullish is we had that big fat green candle last Friday that punched through the resistance level of 457, which was a recent high set in July this year. Okay, enough of the obvious. I am sure you don't watch my video just for the obvious stuff. Let's now talk about the not so obvious things, or basically things to watch in the next 1 or 2 weeks at least. First of all, watch Monday and Tuesday's movements. If SPY does not hit a low that is lower than last Friday's low and continues to close above 457.8, we then have a decent chance to head towards the Fibonacci extension level at 469. And in case you didn't realize, the all-time high of SPY is 467. So yup, you heard it correctly. A few more candles above 457.8 gives us a good possibility to retest that all-time high. But in terms of the timeline, I'm sorry I don't have a crystal ball, so I don't know when it will happen. But yes, there's always a but. I would say SPY is at a pivotal point right now, with two potential bearish movements to look out for. First and foremost, I'm not sure if you could recall, I think some time ago, I said that when SPY hits the middle area of this green uptrend channel, it's the first resistance or test that SPY needs to break before it can go to the top end of the channel. In fact, there were multiple occasions where SPY got rejected in the middle of the channel. On the other hand, of course, there were also times where it broke out of this middle line and hit the top channel. Anyway, the chart is there, you can count for yourself the ratio of rejection versus breakout. My point is, watch this middle channel as the first important resistance. The second movement to look out for is whether SPY can break above this 458 area. If we get a few red candles and closes below 458, then we could potentially have a bearish double top pattern. But the tricky thing about a double top pattern is you need the stock to fall quite a fair bit before it can be confirmed, and some may say it could be too late to enter any puts. Well, it really depends because there are other indicators to help one in identifying a bearish trend. To add on, one can also set stop loss to manage the risk. Okay, let's not go too technical on this, but I hope you got that. The two movements to watch in terms of the downside are the middle channel resistance and this pivotal 458 level, plus minus a little bit. So basically, if SPY gets rejected from here, I would say we then have a decent chance to fill that gap between 441 to 446. From this point, if SPY bounces off this gap area and bounces off the bottom of the uptrend channel, that's very bullish. And in my personal view, this movement is very healthy. Basically, a small 3 to 4%-ish pullback, fill the gap and bounces up. And this movement actually coincides with a typical December market movement, where the first half of December is a little weak as compared to the second half of the month. I will cover more on this later in the end thoughts segment, but the caveat here is there's no guaranteed stuff in the stock market, okay? Moving over to Apple's chart. In my last video, I shared that I was expecting some weakness in Apple, and turned out Apple did pause its bullish melt-up, but it didn't fall much. If anything, it was at most flat, which means it did better than I expected. So yup, I am just being honest here, no running away from my own call or analysis. Anyway, it appears to me that we have a bull flag forming on Apple's chart. For confirmation, watch how Apple moves this and next week within that flag. If we have a breakout from the flag, then I would say there is a high possibility for Apple to charge towards the all-time high of 197.7. When that happens, and if the seasonality bullish momentum kicks in, I think we can expect Apple to create a new all-time high by touching the 200 level. On the other hand, if Apple moves below and out of the blue flag, we may then feel the tiny gap at 186 with the important 61.8 Fibonacci level as support, which sits at around 185. If we can get a bounce from here, then I would say Apple is very bullish. Okay, just like SPY, I personally prefer a slightly deeper pullback to a critical support level, then bounces up. That's healthy in my opinion. To add on, Apple's MACD just had a bearish cross recently, so let's see if a retracement will come. But of course, I could be wrong. Apple may just melt up above the bull flag without any pullback. I mean, anything is possible, right? Anyway, if 185 does not hold, we have multiple support levels below. Therefore, there is no need for the bulls to panic. Some key support levels are 181, which is formed by the 100 moving average and the next Fibonacci level, and around 179, where the 50 moving average sits. In my view, if only 50 moving average gets breached, then I would say Apple's trend has turned bearish. Otherwise, anything above it, any red days or pullbacks are nothing of a concern for bulls. They are just likely a retrace and bounce type of movements. Hopping over to Tesla's chart, on 21st November, I posted on Moomoo that Tesla will probably move range bound between 200 to 240's range. Well, so far this has been the case, with only one day of outlier where it hit a high of 252. Even so, Tesla closed in the 240's range on that day, at 244 to be specific. With the latest Cybertruck event not causing too much sell the news impact on the stock, I am of the view that Tesla will likely stay in this consolidation zone until the next catalyst, which is the New Year period where they announce their latest quarter's delivery. Okay, if you recall, range-bound movement is good for option sellers, right? Not financial advice, but I tried selling a cash secure put contract last Friday, but just that it did not get filled. Okay, if you know, you know. Again, not making any recommendation here, alright? And please set stop loss if needed, because any big whales or institutions' participation can cause Tesla to move out of this consolidation zone. Okay, within the consolidation area, in terms of the downside, watch for 222 to 224 area, because that's a double support area formed by the Fibonacci level and the 200 moving average. I would also like to take this chance to remind viewers that Tesla's surge from 194 to 250 is a good 28-29% rise, and that happened in just 1 month. Tesla basically needs a little breather, it's just a matter of time. In fact, I think we saw that a little bit towards the end of last week, as Tesla fell from 250 to 238. And can you see how Tesla gets rejected so nicely by the purple downtrend line? I mean, don't you love technical analysis? By the way, just to add on, if you can take this 28% right up, you must be able to swallow a say more than 20% fall anytime. I mean, it may not be this month. Anyway, the next critical support is none other than the next Fibonacci level at 212. But just to highlight, that is also where the bottom of the Bollinger Band is. If we ever reach this area, I am expecting some form of bounce. Honestly, from now till year end, I see little possibility for Tesla to break below 200. I could be wrong. Before I move on to the potential upside, spare me 1 minute please. Well, if you think my free content has been useful so far, do consider signing up for my channel membership or buying me a super thanks via the buttons below this video as a form of support. If not, you can consider signing up for a Weibo account at no cost to you. In fact, you actually gain something in return. In short, sign up for an account, fund $1, you get free shares immediately. And then keep the $1 there for 30 days, you get more free shares. Otherwise, do at least support the channel by tapping on the like and subscribe buttons. That will help to push this video to more viewers and grow the channel. Okay, 1 minute is up, let's go back to business. In terms of potential upside for Tesla, watch that purple downtrend line again. Tesla needs to break above it, just like how Apple did it. If Tesla can put a few candles above the trend line, it is actually breaking this bearish trend that started since July this year. By going above this trend line, it also gives us a decent chance to take out the recent high of 268. In fact, conquering this level is nothing. I mean, we are talking about Tesla. 30 points rise from the current level is 12.6%. That's nothing amazing for Tesla, right? The ultimate goal for bulls would be the gap between 280 and 289. That being said, by going above the purple trend line and above 268, it does mean that Tesla has officially broken out of its current consolidation zone and it's considered bullish. At that point, I wouldn't want to hold any short positions, to be honest. And if we hit the gap area towards the year end, then I would say that's the pivotal area, because by then we will be very close to the announcement of Tesla's delivery numbers. From there, it's either we go back to 250s range or we charge towards 300 level. Well, interesting time ahead. Moving over to Google's chart. Ladies and gentlemen, even if you haven't been a loyal viewer of this channel, even if you only saw one of my videos in the last 2 months, you would probably caught the part where I mentioned that Google is consolidating between the range of around 127 to 139, 140 area since July this year, with only an exceptional period where it fell below 127 for a week or so. Given how Google moved within this tight range, it's actually one of the easiest stock to trade at the moment. I mean, as you can see, it hit 139 last week, which is the top end of the consolidation zone that I talk about, and then it fell back down. Therefore, if Google continues this trend and with the MACD having bearish cross recently, there is a chance for us to hit slightly below 130 this week. But just to clarify, this is not a prediction that it will happen. I am not saying that Google will definitely 100% go below 130 this week. It is all about probability. But let's say Google really falls below 130, then keep an eye on 127 to 128 area, which is the Fibonacci support level and the bottom of the consolidation zone. And if we have another case of Google breaking below the 127 area, just like how it did towards the end of October, I would be very excited because it gives me a good opportunity to sell puts. Again, not financial advice, okay? So below 127, I will look out for the level 120. That is the level which it held back in October. And the last time we closed below 120 was about 4 months plus ago, back in July. Just to add on, the 200 moving average is around this level as well. Therefore, if 120 breaks, then it will be an uh-oh situation where we could say Google is very bearish. On the upside, it's basically as simple as it can get. Watch for bounce from Google either from the 130 support level or the bottom of the consolidation zone at around 127, 128 area. But a bounce is not enough. Google needs to take out 139 to 140 area and more importantly stays above it for a while before we can say Google is very bullish. Staying above 140 will likely create a new consolidation zone between 140s to 150s range. Let's now move over to the options trading section. First up, in case you are not aware, I have done a new video on options wheel strategy. Do check it out if you have not, because the first trade to cover is related to the wheel strategy. If you could recall, I sold a cash secure put on Bank of America on 23rd September with $26 strike price, and I received a premium of $35. On expiration date, which was 27 October, Bank of America fell below my $26 strike price, but I decided not to roll the option and accepted the assignment. The very next trading day, I received 100 shares of Bank of America with $2,006 deducted from my account. Almost immediately, I sold a covered call on this 100 shares and received a premium of $80. The strike price was the same at $26, expiring 8 December. Then, very soon the trade went in the money and the stock went as high as $29, $30. And on 30th November, I received a notification that my contract has been assigned. It was an early assignment. In other words, my shares will be caught away before the expiration date. So next moment, I saw 100 shares of Bank of America disappeared from my account and $2,600 got credited to me. To sum this up, it's kinda like I charged the market maker a fee for placing 100 shares of Bank of America with me. The fees or profits I got from this whole process is $35 plus $80, which is $115 less trading fees. And that's it, I didn't lose out on anything. Just like that, I got $100 for coffee. Anyway, this is what I call the whale strategy. That being said, I don't want to paint just a rosy picture and mislead the viewers. So do check out my video on whale strategy to find out more information. And if you have any questions on whale strategy, feel free to ask in the comment section below. Next up, I had this cash secure put on Tesla that expired on 24th November. The strike price was $175 and it was sold on 20th October. Back then, the market overreacted to Tesla's poor earnings by falling more than 10% in 2 days, after which it did continue to fall to as low as $194, but did not go close to my strike price of $175. As a result, my contract expired worthless and I got to keep the full premium of $207. Alright, the last trade to update is this cash secure put on Google with a 115 strike price, expired last Friday 1st December. The contract was sold on 26 October. Again, I seized the overreaction by the market during post-earnings as Google also fell more than 10% in 2 days. And from the point when I sold the contract to the expiration date, Google only went as low as 120, and my strike price of 115 was never breached at all. Just like Tesla's trade, this contract expired worthless and I got to keep the full premium of $160. Alright, there wasn't any video last week, so here's the latest update on my thoughts on the US stock market. Well, last week we saw a bit of profit taking in the big tech stocks, as a few of the Magnificent 7 were slightly red, especially the hotter ones such as Nvidia, Microsoft and Google, which all had a massive run-up prior to last week. But despite investors taking profits off the table, these shares, together with other big tech giants, were big winners in November. So now the question is, will it continue this month? Well, it's hard to predict, but let me share some statistics and my personal thoughts. So, what I observed this year is that the seasonality trend has been quite strong and evident. For example, September has historically been the weakest month for stocks, and guess what? The S&P 500 fell almost 5%. Then, come October, which is usually a weak month with high volatility, we saw the market pop at the start of the month and plunge more than 5% in about 10 days. And then, in my previous videos, I shared that November has traditionally been a strong month. Well, all three major indexes gained more than 8% in November. Therefore, if this seasonality trend continues, then we have good news for the bulls, because December is also traditionally a strong month as well, but not as strong as November. Okay, here comes the interesting portion, and kudos to you if you stayed till here. A research from LPL Financial shows that the second half of December tends to outshine the first part of the month. The S&P 500 gained an average of about 1.4% in the second half of the month, which coincides with the so-called Santa Claus rally. And in case you are not aware, the commonly known defined Santa rally period is the final 5 trading days of the year and the first 2 trading days of the following year. But I would say give and take a little bit. Anyway, what does this mean? Okay, I'm not offering any financial advice here, okay? But I could be looking at selling cash secured puts this or next week. And if this seasonality trend continues, my trades could profit by the end of the month or in January. Again, please do your own research before you trade any options, as things can swing the other way very quickly. Just to add on, I thought I should caveat something here as well. The stock market may face a bit of selling pressure in some stocks because of tax loss selling, as investors get rid of losers to lock in write-offs or losses before the year end. Therefore, researching and selecting the right stocks to trade is very important. But tax loss harvesting aside and a potential slightly weaker first half of December aside, if the existing conditions remain the same to the end of the year or early January, I think the market could hit a new high, something that I have shared in my previous videos. With that being said, just like Jerome Powell, I think I have to also remind investors or viewers, or even myself, not to get ahead of oneself. There may be talks about soft landing, but honestly, the full effects of the Fed's aggressive rate hike campaign may not has yet been felt. I mean, the outlook for the economy is still uncertain given the unstable macro environment. So yup, move carefully in this bull market. If you had caught the rally in November, great. If not, there's no need to chase. The pullback will come. It's not a matter of if, but when. Alright, that's about it for this video. Please help me grow my channel if you found my content useful by liking and subscribing. I'll see you in the next one. Thank you.